Welcome to Market Monday from the investment team in the trust department at the First National Bank. Let's start today off with a quick announcement, and that is on January 31st at 5:30 p.m. at the Yacht Club is our annual investment forum. You're welcome to join us, but space is limited and you do need to RSVP. Potentially you have an email about this, at least you should, but you can also give us a call to reserve your spot, and we're looking for a great turnout there. We're going to be discussing all of the topics in person that we've been discussing in these videos over the past several months and what our outlook is for 2023, allowing for some dialogue as well. So hope to see you there. With that said, let's take a look at the market. And this is the S&P 500, which we all know has been a pretty wild ride over the past year, but it's got some silver linings in this wild ride, a bottoming process that appears to be going on. You know, we found it in June, we found it again in October, and we found it again in December in a different way. And this is the one that's most interesting to highlight because during that period, a lot of folks tend to be on vacation at the end of the year, and as a result, there's less liquidity in the market, meaning if the market has a lot of buy orders, there's not a lot of others there that are willing to sell. So it tends to create exaggerated movements, either up or down, depending on which way the pressure is, whether it's buying pressure or selling pressure, that comes in whenever there's unexpected news. And we did get some unexpected economic results, but the market stayed in a very tight range, indicating some stability. Then we're trickling up as we start off earnings season. And that hasn't been that great. Companies have been announcing cost-cutting measures and potentially lowering their earnings and revenue guidance for the year going forward. And, you know, in the case of banks, they're forecasting a mild, at least, recession in 2023. So with that on the horizon, the fact that the market is acting strong is very good. And we think it's in part driven by inflation, which has come in. And let's talk about that. Inflation is apparently on the decline, as you can see, both in the white line, which is producer prices, and the blue line, which is consumer prices, and the pace at which they're rising. Now, this is notable. Back in June, the producer price index was basically, up there around 16. So producer prices were rising by about 16% on an annualized basis at that time, while consumer prices were only rising by 9%. That indicates shrinking corporate margins because ultimately profits is your sales minus your costs. And if your costs are going up by a lot more than what your sales prices are, which is what that implies, your profit margin is going to shrink and your earnings are going to shrink relative to expectations. And we think that accounts for some of the chop that we saw in the market and volatility last year. That differential has shrunk substantially. And also, it appears, for now at least, inflation is falling in and the Fed can be a little less heavy-handed. So all of that combined with the fact that, yes, banks and most firms out there are now calling for a recession in 2023, plus the historical fact that markets tend to do a bottoming process and at least begin that, which we see evidence of on this price chart for the S&P 500, they tend to bottom and begin that process in advance of recession. So the data is kind of lining up toward the market looking out past 2023 into mid-2024 and beyond and saying, it's going to get over this potential recession. It's going to get over the negative bumps in the road that are forecast. So as we move into what's on the horizon, today we get the leading economic indicator index, which is a conglomeration of different indicators taken together, having predictive power as to what's going to happen with economic growth. That's showing a negative 0.7% expectation there. Again, that's nothing that's unexpected. We get outlook information. This is a big one here, one of two really big reports over the next couple of weeks. The GDP for fourth quarter annualized rate, which is expected to be 2.7% growth. Now, there's more to this, though. Generally, when you see this number, it's an average, and it comes in the middle of at least what looks like a relatively normal distribution. In other words, most of the forecasts are in the middle with a few outliers. Instead, what we've got is this, which shows really no cohesion, and it doesn't give us very much information as to, yes, we can be confident in this number that's out here, this 2.7. we really can't be that confident in that number based on that distribution I just showed you. So, another way of saying it is, with expectations all over the place, big firms are positioned all over the place, and even a surprise in this number is less likely to be as impactful as it would be under normal conditions if the expectations were more tightly aligned. Moving into inventories. This normally, you can tell kind of how important Bloomberg thinks this is by how many bars it gets. It says wholesale inventories and retail inventories are not as important. We're going to beg to differ on this one because as we enter recessionary type conditions, we want to know what's happening with inventories. We know that in the recessionary conditions are what the expectation is. So if we see inventories rising at the wholesale level, that means retailers are cutting back purchases in anticipation of lower sales. And on the other hand, if we see retail inventories growing, that means consumers are already tightening the wallet and retailers are left with inventory sitting on the shelves that'll eventually have to be marked down. And so we're watching this for its market implications. Rather the earnings expectations implications that it will imply. So we'll get information about the health of demand, the real estate market, incomes and spending. This deflator normally doesn't have much power to move the needle, but it might, because that does represent inflation to a degree, and any unwelcome surprises here that show inflation being higher than expectations might tilt the Federal Reserve toward raising more than what's expected, which, let's get to that because that is the most important thing that's coming, and that comes on the 1st. The Open Market Committee's rate decision now is expected to be 25 basis points instead of the 50 it was last time and the 75 it was for several times before that. In other words, they're able to slow their pace, and that's what the market expectation is. If we get more inflationary surprises, if we get strength in the economy that appears unexpected, that may change. And an unwelcome surprise here, a 50 basis point hike, could potentially cause some heightened volatility. So we'll be watching that as well. Again, more information about demand and sentiment will round out those numbers. Now, last item to discuss, rates. It's a great environment for income investors in terms of corporate bonds, but this yield curve here, which is the Treasury curve, is a clear indicator that we're facing recessionary pressures. When you look out and you see a 2-year rate that's higher than a 10-year rate, which the 2-year rate's 4.215, the 10-year rate's 3.534, that indicates that there's a potential recessionary situation. And out here too, this longer term of the yield curve, 10-year rates being about 3.5%, that also indicates that potentially the Federal Reserve is not taking inflation down to 2%, which is the former target it used to be, but it's going to remain higher. 10-year rates and beyond tend to reflect long-term inflation expectations. The fact that they've reset in the mid 3% range indicates that potentially inflation is going to reset more in the 3% range also. So it bears watching. With that said, again, rough year, but all is not lost. And remember, we're taking the long-term view. The long-term view is a lot calmer and a lot less cause for concern. And this is our outlook, 5 years, 10 years, 20 years. We're not going to be making changes in short-term, of a short-term nature to long-term investment plans that are doing very good. So this chop is a little bit nerve-wracking, but ultimately it's limited in scope. We want to focus in on the big picture. If you have questions, if you have concerns, we're happy to talk to you and we're here for you. We hope your New Year's off to a great start, and thank you. Hope you've enjoyed.